What is wrong with gold? Right now, gold is down, and most importantly, it's down since the military campaign against Iran started. How is that possible? Isn't gold a safe haven? Isn't this exactly the type of environment that gold should thrive on? Geopolitical tensions? Well, yes, that's the textbook definitions. And to some extent, it's true. Gold is a safe haven. And in fact, it rose into the expectations of the event. But there's a missing detail here, because here's the problem. The definition that gold is, safe haven is true, but it's incomplete. See, there's a specific, almost invisible to most traders, mechanism that is driving actually gold right now, which we'll get into a second. But the point here is that it's extremely important to understand what this driver is. If you follow us, you already know what we're talking about. It's extremely important to understand what's going on behind the charts, behind gold right now, in order to not get caught into buying the dips too early, because as long as the context does not favor dip buying gold, it's going to be a little bit problematic. See, the point, as I just explained, is that gold is not just a safe haven. Now, it's a safe haven, yes, but it's not just a safe haven. See, gold is a rates asset. It trades on the opportunity cost between bonds and gold. See, right now, in this specific moment of time, the rates side of the equation is absolutely crushing the fear side, the safe haven side, because this is what's happening. Every single time there is an escalatory comment, an escalatory development in the Middle East, oil prices rise. As a result of that, inflation rises, inflation expectations and inflation risks rise. And so here you would say, well, gold is actually an inflation hedge. Well, not exactly there too. Gold is not exactly an inflation hedge. Gold is an hedge against, a loss of confidence in central banks actually being able to fight inflation. But what's happening now is that most central banks are actually turning hawkish because of the rise in inflation. We're seeing the Reserve Bank of Australia hiking. We're seeing the Bank of Japan about to hike. We're seeing the European Central Bank about to hike. We're seeing the Federal Reserve not hiking, but keeping rates higher for longer, and potentially even considering hikes if they need to. So central banks across the globe are starting to fight inflation already. And as a result of that, yields rise and real rates also rise. For that single reason, which is a chain of mechanism. It's a mechanism that brings us to gold getting dragged lower by all this chain of events. Now, this is the mechanism right here. The same geopolitical event that should actually be bullish for gold, that should bring people into gold, into a safe haven. Well, that exact same event is actually bearish for gold through a completely different channel, which leads from, higher oil prices, inflation, hawkish central banks, treasury yields rising, and gold actually for that falling. So the market is basically saying, yes, geopolitics are a risk, but if that risk keeps going and keeps oil elevated, most important, and when inflation comes back, and if inflation comes back, central banks are going to hike. And if the central banks are going to hike, gold falls. Now, it's the same thing that happened in 2022. Now, at the beginning of March, when the whole geopolitical saga started, I actually thought, to be honest, that this was going to be completely different from 2022 because we're coming from a completely different context. Now, in 2022, we were coming from excessive liquidity, excessive monetary stimulus from central banks, very low interest rates, massive QE programs and all that. And so central banks were in a position to hike rates aggressively, which they did. And I'm going to get to that in a second. And I thought, well, 2026 is different. We're not coming from excessive monetary stimulus. We're actually in a very complex and vulnerable macro context where growth is actually very vulnerable. But yet the market has actually decided to see that completely different, and we have to adjust and adapt to that. And basically, the point is that the market is seeing this as exactly a similar to 2022 scenario. If we go back to February 2022, we see obviously that Russia invades Ukraine, and gold spikes on that. Obviously, it was rising already in anticipation of that. A similar kind of setup that we saw actually this year, where gold was rising in anticipation of the geopolitical escalation, and in this case, it had quite a bit of a jump after that. This year, it didn't. But the point is that the first move, it makes complete sense in this case. Obviously, fear rushing to safe havens, textbook. But then right here, the market started to ask a different question, a second question, a more important question, a more longer term question for gold, which is, how is this war, how is this context going to impact inflation and central banks? Well, the answer was in that case, and in a similar case right now, that this was going to lead to higher yields, in this case real yields, but yields as well, and a central bank, in this case the Federal Reserve, but every central bank started hiking aggressively except the Bank of Japan, but that's another story. They started to hike aggressively, 75 basis points, 50 basis points. Now, right now they're not hiking yet, except for the Reserve Bank of Australia, but they're about to hike. Most central banks are about to hike. The European Central Bank is about to hike, for instance. The Bank of England probably is going to hike a little bit. And the Federal Reserve is definitely going to keep rates high. So this is what happened in 2022. Yes, we got the geopolitical crisis, obviously, but then inflation started to rocket. The Fed started to hike rates aggressively, and yields exploded higher because interest rates and interest rate expectations were absolutely rocketing higher. And gold, despite a literal ongoing war, lost its momentum and started trending lower. Okay? What I'm trying to say here, and I want you to deeply understand this because I've got a lot of questions about why is gold down despite the geopolitical tensions. Well, the reason is that gold is not just a safe haven, but it's also a rates asset. Okay, so the point that I want you to really understand is not to rush into gold just because the geopolitical context says so right now. Now, before this was another story. We took many longs on gold heading into the geopolitical escalation, but then once we saw that the market started to take into consideration the fact that yields were going higher and that interest rates expectations were going higher because of the energy crisis, gold started dumping, and that reshaped our understanding of the fact that, hey, the market is actually taking this exactly the same way it saw it in 2023. Interest rates higher, inflation expectations higher, yields higher, and hawkish central banks. So this whole point is that gold can still fall further if rates expectations continue to rise, if central banks across the world continue to push in a hawkish direction, which they are doing, by the way, and in fact that's why we're seeing gold still heavy, still pressured. And so the market is seeing the spillover effect. It's pressing gold through higher oil, higher interest rates expectations, fewer rate cuts. We went from context before the geopolitical escalation where every central bank, many central banks, pretty much every central bank was cutting interest rates. The Fed was expected to cut further this year. Many central banks were expected to cut. And that's why gold actually was bullish into March 2026. But after that, things changed. And I want you to understand that as long as those things remain in place, well, gold is going to keep a little bit heavy. So look at the bond market, look at what the yields are doing, look at also what oil is doing, because counterintuitively right now gold needs lower oil because lower oil would allow central banks to actually get a little bit more dovish. Okay, so the point is this: don't read gold only as a geopolitical safe haven right now. The story goes deeper than that. It goes into interest rates expectation, it goes into monetary policy, it goes into central banks. So as long as most central banks are hiking interest rates, are hiking or potentially hiking interest rates, at least keeping rates very high, gold is gonna get a little dragged lower. And as soon as that changes, as soon as central banks start to turn dovish, so from higher for longer to, hey, we're gonna probably need to cut rates because growth is deteriorating fast, then that's when we're gonna start looking to long gold back above 5,500 and so on and so forth.